And then the last thing that you conclude is that that increase in sanctions risk could bolster the long run fundamental value of both cryptocurrency and gold. And so we already talked
Yeah.
about gold as something that central banks are adding. Talk a little bit about cryptocurrency as a whole, and then you specifically single out Bitcoin in the paper a number of
Yeah.
times, and kind of talk about why you think that could become one of these like imperfect substitutes.
The paper really thinks about cryptocurrency, and so let me actually start with the second part of your question, which is sort of why Bitcoin. Bitcoin is by far the largest cryptocurrency, and Bitcoin and Ether combined are like 70% of the market value of all cryptocurrencies. So, just looking at Bitcoin gives you a pretty good proxy for the sort of the whole non-stablecoin cryptocurrency market. And non-stablecoin is kind of important here because stablecoins don't really help you if you're worried about sanctions, because U.S. dollar coin and Tether can be sanctioned, and because of the way they hold U.S. dollar collateral, they can probably be bullied by the U.S. government into implementing sanctions if that's really what the government wanted to go down that path. So really, when it comes to cryptocurrency, it's got to be sort of the fiat, so the fiat cryptocurrencies, and it's got to be, for a central bank, it's got to be cryptocurrencies that are big, where you can conduct potentially $1 billion transaction, let's say, without having a massive impact on the market price. Bitcoin, of course, today is a lot smaller than it was when I first started writing this paper. I think it was like $40,000 maybe around the time that the sanctions were applied to Russia. But it's still, the market cap's what, 300 billion, something around there. So it's plenty big enough to conduct not transactions of non-trivial size. As far as the fundamental value is concerned, I think there are a lot of use cases for cryptocurrency that involve just transacting. It's sort of like you exchange fiat currency for crypto. Let's say you then send the crypto as a remittance to somebody somewhere else in the world. And then that person swaps the crypto for another type of fiat currency. So that type of transaction is not really going to contribute to a fundamental value, because it's just buying and then reselling. So the real question when it comes to fundamental value is who's going to be holding on to this stuff. And this paper kind of conceives of cryptocurrency as being a form of insurance. Holding on to it gives you insurance against the possibility of you facing sanctions and having a large portion of your wealth sort of potentially destroyed. In that scenario, you still have these digital assets and also maybe gold. And so that generates the incentive then to hold on to this stuff, sort of to protect yourself. And so that's the sense in which it's insurance.